With the headlines filled lately by stories about President-elect Donald Trump's efforts to save 800 manufacturing jobs in Indiana from moving to Mexico, the real news that investors care most about has been totally lost. Today, just 10% of U.S. jobs are in manufacturing. Although manufacturing accounted for 37% of America's jobs in 1950, the economy changed over the past 66 years. Job losses occurred in manufacturing, but were more than offset by job growth in education and health services, as well as professional and business services, sectors with much higher paying jobs than manufacturing. This is a really big story that doesn't get covered very often in the media. Ironically, if the financial press did cover the economy from a perspective that really affects American investors, there has been real news to report, and it's good news. The 90% of the economy outside of manufacturing has been growing robustly. The 57.2% reading in the Institute for Supply Management's Index of Non-Manufacturing Activity in November was a jump of 2.4 percentage points over October's reading. This indicates that the non-manufacturing sectors of the economy, the source of 90% of America's jobs, are continuing to grow. The way the index works is that a reading of more than 50% indicates the non-manufacturing sector of the economy is generally expanding, while a reading below 50% indicates the non-manufacturing sector is generally contracting. According to ISM, November's 57.2% reading historically corresponds to a 3.3% increased growth rate in the U.S. economy on an annualized basis, and it was the 82nd consecutive month of growth. The good news comes on the heels of last week's report of a sharp drop in the unemployment rate in November from 4.9% to 4.6%, and creation of 178,000 new jobs. In addition, the final growth rate for the third quarter of 2016 was revised upward to 3.2%, while the consensus forecast of about 70 economists interviewed by the Wall Street Journal in early November called for growth of 2.3%, clear through the third quarter of 2017. Average hourly wages have been rising and inflation has been dormant. That makes the Fed unlikely to tighten credit and accidentally cause a recession, which is how most expansions end. The U.S. economy has been in a virtuous cycle in which a chain of good economic news has triggered more good news. How long can it last? At 89 months, this expansion is neither young nor old compared to the previous growth cycle since World War II. Recessions trigger bear markets, but not every bear market was accompanied by a recession. A bear market without a recession is certainly possible. Generally, stock prices bounce up and down by 10 or even 15% because of changes in sentiment. And you have to always expect that kind of volatility. But key growth indicators in the economy have been strong. This expansion could go on for years, and it's not showing any signs of ending. At a time when stock prices are breaking records, concern is growing about fake news. We are a trusted source for financial news and analysis, based on economic fundamentals and authoritative data sources. We offer you financial news and analysis independent of big media, Wall Street, or politics. Prudent analysis of news affecting your wealth over the long run.